I'm here right now with somebody who has been in this market for a very long time, Ken Kencel, President and Chief Executive Officer of Churchill Asset Management. It has about $50 billion under management of private capital as the affiliate of Nuveen. In many ways, we've seen this regime change. We've been talking about it. We've been talking about with public debt markets in terms of 50 basis point rate cut. It changes everything. Private credit markets have been pretty hot for a long time. But how much have you seen in some ways a turbocharging of the activity that already has been going on in private credit?
Yeah, well, great to see you, Lisa, and great to be back again and chatting about private credit, my favorite topic. So I would say that certainly the decline in rates and the more normalization as we head into the new rate environment has been a real spur for economic activity, certainly deal activity in the private credit market. We had about $33 billion of activity in the second quarter. That is the most active quarter in private credit that we've seen in the last 3 years. As a firm, our activity is up, over double in the past year. So I think that rates coming back and more normalized rate dynamic is good news for private credit. It's certainly good news for companies that are trying to address, the higher rate environment. So I think that's also taking some pressure off, underlying businesses. So I think that all points to what will be a very active 2025. And certainly we are extremely active now as we head toward the end of the year.
So you're tasked with actually looking at the balance sheets and understanding how healthy these companies are, what their business propositions are, whether they're going to get paid back. And, there's been this big question right now. Are we on the precipice of some sort of downturn? Are these companies actually accelerating their revenues? Are margins expanding? Are they shrinking? What are you seeing? How attractive are the companies coming to you saying, we just really could use a loan?
Well, interestingly, I would say in terms of the quality of the companies we're seeing and the quality of the deal flow we're seeing, certainly over the last couple of years, it was really only the highest quality businesses that could really put themselves up for sale, right? Because they had a good story in terms of performance, an ability to pass on price increases, which were significant, and frankly, private equity, who were looking to drive exits and drive returns of capital, saw that with their highest performing businesses. So I'd say historically over the last few years, it's been the highest quality companies, and deal flow that we're seeing today is still pretty much reflective of that. So there's areas like software, business services, healthcare, high quality businesses, strong recurring revenue, market leading companies. That is generally what we're seeing in terms of the deals that are coming to market and being sold, which of course drives private capital, private credit activity, and of course private equity investment as well.
So if there are mostly high quality companies that are looking for loans, more higher quality, I should
certainly
say.
in the new deal environment.
The new deal environment,
yes.
Right? Not maybe the existing deals, all
correct.
of them.
Yes.
There is everybody and their mother who wants to get into private credit right now, it seems like. It seems like this is an incredibly popular area. How do you source good deals on good terms at a time where you're facing off with a lot of competition?
Sure. Well, look, I think there are a few things now driving the private credit market that are, pretty important if you think about driving quality deal flow. Well, one is that the largest scaled private credit direct lenders are really in a very unique position, because it's only those 5 or 10 firms that can write a $500 million, $1 billion financing check and can deliver a one-stop solution to their clients. So it's a small universe of firms that really have that, and those firms are the ones that are seeing the lion's share of deal activity. Those are the firms that are driving high-quality performance to investors, which of course begets raising more capital. And I would say that there's a bit of a shakeout in private credit today. I would say that the largest direct lenders are taking share and seeing the better opportunities from a lending and financing standpoint. And those are the firms as well that I would say have this historic relationships with the private equity community. If you think about firms that have done 10, 15, 20 financings for a private equity firm, those are the firms that are going to get the first call. And so as a result, I think that you've seen a bit of a bifurcation, both in terms of deal opportunities and financing, but also I think in terms of portfolio performance.
How much do you see companies consolidating with one another versus just the ones who aren't big enough, who don't have the track record, just going out of business?
I think there's going to be smaller managers that have built a good track record, but maybe find themselves pressed in terms of capital raising and the ability to keep up, if you will, in terms of being able to provide capital to their clients. So I think you'll see, particularly particularly firms that are not in private credit. So some of the traditional asset managers that have recognized that private credit has a long-term seat at the table, if you will, that need that capability, want to deliver that capability to their clients and their investors. And so I think you'll see some of these smaller teams, and we've already seen it, kind of snapped up, if you will, by the traditional managers, and I think you'll see some M&A activity there. And also some of the large alternative managers looking to get into niches where there may be great growth opportunity, but they need a team that can really approach and address that opportunity.
When you talk about consolidation, a lot of people have wondered whether we're going to see consolidation among regional banks. Maybe the better question is, how much do the questions around the health of some regional banks open up opportunities for people like yourself to really get lending share in a lot of these particular geographies?
Sure. No, it's a great question. And if you think about private credit over the last 10, 15, 20 years, it's really been the story of cash flow lending, right? Traditional cash flow based lending, mid-market companies. Where the banks have historically continued to play are in those smaller regional businesses, asset-based lending, inventory finance, more asset-based activities. And I think what you've seen are the largest alts managers now that are saying, wait, there's not only an opportunity here in traditional cash flow lending, but also in some of these more niche areas where banks historically have played, where they are starting to reduce their capital allocations and are looking to kind of pull back on some of their investment activity. And you've seen some M&A in around ABL in areas where the asset managers are looking to expand their footprint.
And we've also seen a number of banks say, we don't want to lose these clients. We're going to go partner with, say, I don't know, Apollo. We're going to partner with this consortium over here. Would you ever be interested in partnering with a big bank?
Absolutely. Look, I think the banks have great client relationships. They've got long-standing credit cultures. They are looking for ways to leverage those relationships and deliver more for their clients. The question really is, does the economic model work for them in terms of delivering that financing and that capital? And I think increasingly banks are saying, look, we have great relationships. There's real value there. How do we deliver alternative solutions to our clients? So, for example, forming a partnership to be able to offer a larger syndicated loan client not just an underwritten, distributed syndication, but also a fully committed private credit alternative that is literally a one-stop shop. Here's your commitment letter, and oh, by the way, you're trying to do an M&A transaction in 3 weeks, and so speed and certainty and confidentiality are all important. I think that the large cap market certainly has now become one where you really have companies choosing between a syndicated alternative or a private credit alternative, and banks realizing that are looking for ways to form partnerships to be able to deliver those opportunities.
We're talking about all these ways that companies might be interested in taking actions. And I talked to some executives who say, I don't want to take any actions ahead of, in particular, the election, given the fact that there could be a lot of potential differences in policy, et cetera. How much do you see that? I mean, with the clients, the companies you lend to, just in general, just a reluctance to really make big moves?
Certainly in the middle market, our market and all of our financing are for companies owned by private equity firms. And I would say there is a tremendous desire to create liquidity and to deliver capital back to investors. As I think the last 2 years haven't been great in that regard. Distributions by private equity firms, have been very low for the last couple of years, and really as a result of M&A activity. So I think private equity is absolutely gearing back up for increased activity, both on the new deal side. We've seen that in continuation vehicles and in secondary vehicles, where private equity firms are picking one of their 2 or 3 most highest performing businesses and putting them in a CV and selling them to a continuation vehicle in order to create some liquidity for investors. So I think we're at a point where, yes, there's a little bit of hesitancy regarding the election, but I think that hesitancy will obviously give way to significant activity in 2025.
I could talk to you for the rest of the afternoon. Unfortunately, we have to leave it there. Ken Kencel, President and Chief Executive Officer of Churchill Asset Management, a pleasure having you on set.